Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about the most common types of life insurance products, how they work, and who they are and are not suitable for. Let's get started. Hopefully you've watched my last video on what you should know before you buy or switch to a new life insurance policy. If you haven't, watch it when you get a chance to. I'll put the link at the end of the video and as a pinned comment. A basic overview of life insurance is that it comes in two forms: term insurance or permanent insurance. Term insurance is designed to provide protection for a limited time period. Permanent insurance is designed to provide lifetime protection along with a savings or cash value component. So let's start with term insurance, and then I'll go into detail on two types of permanent insurance. Here are some general characteristics of term insurance: the lowest cost life insurance protection for a specified amount of time and coverage. Term is significantly cheaper than permanent insurance until the guaranteed level premium period ends. After the guaranteed level premium period, premiums increase almost exponentially each year. Term insurance can be converted to permanent coverage, usually within 10 to 15 years of purchasing the policy, up until a certain age. Term conversion allows the insured to keep their health status from the term policy without having to retake a medical exam or show evidence of insurability. Term conversion must be converted to a permanent product within the portfolio of the same insurance company. Some conversion choices are limited depending on the term policy or rules set by the insurance company. No cash value. Policy will not grow in value or be of any value while the insured is still alive. One of the main benefits of term insurance is the ability to convert the policy without taking another medical exam at the time of conversion, which I feel is often overlooked with life insurance. After purchasing a term insurance policy, even if there is some medical condition that would normally preclude you from buying life insurance, term conversion can turn that policy into a permanent policy. If you applied for a new policy instead of doing a term conversion, you may be declined or table rated. There are three different types of term insurance that vary in how the premiums are structured and how long the coverage is in force for. The most common one is level term coverage, which sets both the annual premium and death benefit to be level for typically 5, 10, 15, 20, or 30 years from the time and age that the policy is issued. Usually 10, 20, or 30 years are the most common, but the insured's actual age when the coverage ends is significant because most insurance companies do not offer term insurance coverage beyond age 80. For example, if you are age 60 and trying to purchase a term policy, you would not be eligible for a 30-year policy and most likely will not be eligible for a 25-year policy either, as most insurance companies do not offer term coverage beyond age 80. Coverage can extend past the guaranteed period, but the premiums increase almost exponentially, and from that point the policy turns into the next type of term insurance, which is yearly renewable term, also known as annually renewable term. Yearly renewable term YRT or annually renewable term ART is a one-year term policy that renews each year when the premium is paid. By renewing each year, the premium increases from year to year, even if the increase is minimal and by only a few dollars. Essentially, the insured will pay annual premiums as if they are buying a term policy 1 year older each year. Over time, the premium increases start becoming more substantial to the point where a level term policy would have saved money, and that is usually around age 40 to 45. The main benefit of yearly renewable term is that coverage can go beyond 30 years, which can be longer than a level term policy can provide as long as premiums are paid on time and in full. But that does not mean it will provide coverage beyond age 80. A yearly renewable term policy coverage is in force from the time the policy is issued until premiums are no longer paid or until the maximum coverage age, usually age 80. Other than the premium structure and potential duration of a yearly renewable term, it works in a very similar way to level term. Here's an example of what a yearly renewable term illustration looks like, and there are several columns to look at with different values. The key items to look for on illustrations, especially on the ledger pages that have these columns, are the amount of death benefit or total insurance coverage, annual premium outlay, and cash value if there is any, which there isn't for term insurance. Some illustrations show the values at each age by year or by age, When it shows it by age, just add the issue age from when the policy was taken out to whichever year you are reviewing. Return of premium term, or ROP term, I think is the most interesting type of term insurance, but is definitely not for everyone. ROP term is structured like a level term insurance policy with level premiums for 5, 10, 15, 20, 25, or 30 years. Think of term insurance in general as renting your insurance coverage, similar to if you rent somewhere to live. ROP term changes this definition a bit because unlike normal term insurance where there are only two outcomes, the insured lives beyond the term coverage or the insured does not. And considering that term policies historically have an extremely low percentage of paying out, which is around 1% or less, that would mean the insured throws away all the money that was paid into the term policy if they outlive or drop the term insurance coverage. ROP term changes that and creates a bit of a third outcome. At the end of the level term period, if the insured is still alive, all the premiums are not lost. The total sum of all premiums paid into the policy without inflation is returned, but only if the insured outlives the coverage. So you might be thinking, well, then everyone would get this ROP term insurance then, right? Not really, because the equivalent level term policy is about half the price or less, which makes people less interested in ROP term. But also, many financial advisors either don't mention it to their clients as an option or aren't aware that it's available since most insurance companies do not offer it as a term product. So who should and should not consider term insurance? Term insurance is ideal for younger ages, but costs increase as age increases. It's also good for people who need coverage for a specific period of time. Term insurance can also be purchased to provide a mix of coverage between duration, costs, and needs. Term insurance is not ideal for those that need coverage beyond age 80 or for estate planning unless the term policy will eventually be converted to permanent coverage. Here are some general characteristics of whole life insurance. The highest cost life insurance protection, but offers guarantees under certain conditions. Permanent life insurance that provides a guaranteed death benefit and builds cash value over time as long as premiums are paid on time and no loans or withdrawals are taken from the policy to negatively impact cash value. Cash value is guaranteed to increase each year and will never decline in value due to market conditions. A whole life policy can be paid up assuming that all premiums have been paid on time and there are no loans on the policy at the end of the payment period. If the policy is paid up, it is guaranteed to remain in force with no additional premiums due. Can earn policy dividends or additional interest which are not guaranteed. Dividends or additional interest are generally used to build additional cash value, also known as paid up additions. They can also be used to pay future premiums or be paid in cash to the policy owner. Over time, especially when dividends or additional interest are untouched in the policy to grow, whole life insurance can build enough cash value to provide supplemental retirement income, fund education costs for children, or left in the policy to increase the death benefit passed on to beneficiaries. Whole life insurance provides coverage for the entire lifetime of the insured. Whole life coverage stays in force until either age 95, 100, or age 120, depending on how recently the policy was purchased. Policies purchased after 2009, the coverage age has been extended to age 120 to accommodate longer lifespans and not outliving policies. Whole life does not have flexibility in the premiums once it's in force, so when a policy is purchased, the payment structure must be determined up front. The typical whole life payment structures are pay to age 100, pay to age 65, and 10 pay or 20 pay. Paying to age 100 or age 65 will have the lowest annual policy premiums by extending the payments until the insured is age 100 or age 65, regardless of what age the whole life policy was purchased. The 10 pay and 20 pay whole life policies are paying 10 or 20 annual premium payments. Some insurance companies offer options between 10 and 20, like a 15 pay as another alternative. Paid up additions are additional whole life insurance coverage that is purchased with policy dividends instead of premiums paid into the policy. Paid up additions add value to both the death benefit and cash value to compound over time as long as they remain untouched within the policy to grow. Paid up additions are one of the main benefits of buying a whole life policy. Similar to receiving dividends from investing in a stock that pays out dividends, and using those dividends to buy more shares for compound growth, except with whole life insurance, is purchasing more death benefit and cash value. While paid up additions make whole life unique, what makes whole life stand out from other types of permanent insurance options is the minimum guarantees on both death benefit and cash value. While there are guarantees, this means the policy premiums must be paid in full and on time in order for those guarantees to remain in place. Any deviation or missed payments can impact the guarantees on both the death benefit and the cash value. Additionally, mutual insurance companies generally also offer a dividend to policyholders in addition to paid up additions within whole life, which can further boost growth in the whole life policy. The tax-free growth within the cash value can provide supplemental retirement income or fund education costs for children in the future, which I talk about in my video on 529 plans, which I'll link in the comments or description. So who should and should not consider whole life insurance? It's suitable for people who find comfort in having some guarantees with their life insurance on both death benefit and cash value. Most guarantees within life insurance are usually on death benefit only, so that's important to point out. Generally, whole life is fairly expensive even when compared to other types of permanent insurance coverage, but that's due to the guarantees offered and that the cash value can eventually be loaned against tax-free as long as the policy remains in force. At that point, the cash value can be used in any way you like, such as an income stream for a certain period of time or a lump sum. Though keep in mind you really wouldn't want to go overboard on loaning against the total cash value. A rule of thumb is to not go over 75 to 80% of the total cash value available because it can cause the policy to lapse, which would cause potential tax issues unexpectedly. Whole life is not suitable for people who do not have a large amount of consistent discretionary income to pay for the policy. It's also not suitable for anyone that needs some flexibility with the premium payments. The premiums within whole life are level throughout the contract, and even missing a payment can impact the guarantees. If the need for coverage is also a specific or short period of time, then whole life coverage is not necessary. And lastly, if the policy will be used to pay for estate taxes or fulfill other parts within an estate plan, the cash value component of whole life may be unnecessary, while making the policy also unaffordable when a different permanent insurance product like No Lapse Guarantee Universal Life or GUL can be a more cost-efficient option. Here are some general characteristics of No Lapse Guarantee Universal Life Insurance. A medium cost for life insurance protection, but offers guarantees under certain conditions. GUL is a universal life policy with a feature that can guarantee the policy's death benefit or other benefits like a long-term care rider or chronic illness rider, regardless of if the policy's cash value drops to zero, as long as certain premium requirements and payments are met. The duration of the guarantee period is determined at the time of purchase and may extend to a specific age or the policy's maturity. The duration of the guarantee is correlated to premium payments being made on time and the structure of the premiums, but it has no correlation to the policy's cash value or the crediting interest rate of the underlying universal life policy. Any changes to the payment structure, even a change from paying annually to monthly, could impact the guarantee along with missing a payment or late payments. If severe enough, it could lapse the policy. Also, adjustments to the death benefit could impact the guarantee. A no-lapse guarantee can either be reinstated or a certain amount of it can be reinstated. It could be reinstated at a potentially significant increase in premium, depending on how quickly action is or is not taken. Request in-force illustrations on GUL policies from the insurance company at least annually to be aware of any potential impacts to what was purchased and to make sure the guarantee remains intact. No Lapse Guarantee Universal Life Insurance is essentially a term insurance policy that is guaranteed for life or until a specified age. There is generally no cash value except maybe within the first 5 years or so of purchasing the policy, depending on how large the death benefit is or if there was a 1035 exchange from replacing a different policy. There really are no bells and whistles with this type of policy. It guarantees a death benefit until a specific age so that the insured does not outlive the policy as long as premiums are paid on time, regardless of whether the cash value drops to zero. This is widely used for estate planning to maximize the amount of death benefit that can be purchased per dollar spent on annual premiums. For cases that do not involve complex estate planning, GUL can be used simply for protection on a spouse or passing on wealth to children. In that case, LTC riders or chronic illness riders are another option to be added on to a GUL policy. I talk about these two riders in more detail in my video about what to know before buying or switching to a new life insurance policy. So who should and should not consider GUL insurance? It's suitable for people looking for death benefit protection only without the need for cash value. It's a good alternative to whole life insurance due to being lower cost from lacking cash value. But since there is no cash value, if in the future your needs change or you change your mind about the policy, there will be no cash value to retrieve if the policy is surrendered or if the premium payments can no longer be paid. Fluctuating future income or short-term coverage needs for life insurance are not suitable for GUL. To summarize the three product types I mentioned, most people can buy some combination of these three product types in varying death benefit amounts and premium payments in order to get sufficient coverage for their needs. Keep in mind you can have more than one policy or policy type. There is nothing locking you into only having one life insurance policy. The remaining permanent insurance product options require more maintenance to make sure they stay in force or perform the way you might hope or expect they will, and are much more complicated to keep track of and could require more premiums unexpectedly. The guarantees offered by whole life or GUL, especially when buying permanent life insurance, makes them great options as long as the annual premiums are paid on time and in full. Other types of universal life policies, while they offer flexibility as far as premium payments, they become adversely impacted by not receiving enough premium payments or changing interest rates that could actually require even more premiums to be paid than expected. In my opinion, I think that trade-off of not knowing whether your coverage will protect you or not in any given year makes no sense at all. I would think that if most people buy life insurance, they would want protection as long as the annual premium is paid, and not only under certain conditions, or if interest rates change, then you may need to pay more, or the coverage may not last as long as expected. There are just too many variables with universal life insurance, stemming from the flexibility of premiums paid into the policy and branching out to interest rates impacting the policy and needing to request an in-force illustration annually. Realistically, most people don't even request an in-force illustration more frequently than every 3 to 6 years, unless they have scheduled annual reviews with their financial advisor. Talk to a financial advisor and find out what life insurance products and what amount of coverage works best for you and your family. Please check out my other video on what to know before buying or switching to a new life insurance policy, which I'll link at the end of the video, in the description, or as a pinned comment. Let me know in the comments if you want to hear more about universal life insurance products, and I can make another video on them in the future. Do you have any experience or questions with your life insurance, or any thoughts after watching this video? Let me know. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.